Okay, boleh start. Assalamualaikum warahmatullahi wabarakatuh and good day to Madam Saliza and my fellow friends. As for today, we'll present the group assignment for Audit 689. Before that, let me introduce my team members, which consist of me, Alia Zulaika, Nur Hanini, Aisha Fariha, Nur Hanisa, Aufa Shaira, and Amirul Adnan. Next. Without wasting time, I will start with a bit of introduction for the assignment. So generally, there will be two topics which will be discussed further in this video. As for the first topic, I will start with money laundering, which can be described as a process of converting cash, funds, or property derived from criminal activities. So it is like clean the dirty money to disguise criminal origin. Next, tax evasion, which is the illegal way to misrepresent the income to prevent paying tax. Then, fraudulent financial reporting, which is one of intentional overstatement or understatement of balances in financial statements resulting in huge losing in company, and it is difficult to spot. So I will pass to the next presenter.
Thank you, Alia. Now, I will explain about the differences and similarities among these three activities. Money laundering, tax evasion, and fraudulent financial reporting are the completely different criminal offences that happen to involve money. While they do bear some similarities, there are separate offences that do not necessarily overlap. Besides having a different concept and meaning, they also have other differences too. One key difference between these three offences is the source of the money in question. Money laundering must involve money that was obtained through some illegal means. The money typically has been obtained through a specified unlawful activity (SUA) with certain degrees of knowledge or purpose. The money is then put through numerous transactions, often involving different banks and financial institutions, to create a very confusing and untraceable trail. Many Money laundering is different from tax evasion and fraudulent financial reporting because it inherently involves a different crime and does not necessarily involve taxes. The money must come from SUA. If there is no SUA, it indicates that the money was earned legally, thus there can be no money laundering. Tax evasion and fraudulent financial reporting, on the other hand, does not require money obtained through unlawful activity. Instead, the money is often obtained through legitimate. To be summarized, money laundering requires the money to come from SUA, while tax evasion and fraudulent financial reporting can be performed with any money from any source. Money laundering must involve another underlying crime or offense, while tax evasion and fraudulent financial reporting does not. Next. These three offences have their own motivations and purpose. Money laundering is a technique used to conceal the sources and ownership of money or assets acquired from illegal activity, which is to avoid any prosecution, conviction, and confiscation of the criminal funds. The goal of money launderer is to make the dirty money that obtained through the source of drug trafficking, human trafficking, crimes, gambling, smuggling, and many more to appear as a legitimate funds. Therefore, it will not be easy for an authority to investigate money launderer cases as it typically involves numerous parties. The main purpose of money laundering is to take advantage of criminal activities. However, tax evasion is done with a motive of presenting fewer profits in order to avoid tax burden. The goal, the goal of tax evasion is quite obvious. An individual engaged in tax evasion in order to significantly lower the amount of taxes they are required to pay on their profits. Taxpayers are often attracted to these illegal methods of tax evasion as they promise significant tax savings and require less effort and planning than legal tax avoidance strategies. On the other hand, people who engage in fraudulent financial reporting always discover unique methods to manipulate figures to a company's benefit. Their purpose is to make a company appear as successful and profitable as possible, and they will occasionally do it by manipulating the truth. It also occurs in an effort to attract as many investors as possible and secure the demand for stock market shares. Financial statement fraud may also be committed for personal gain, keeping the business afloat, to secure loan approval from a bank, or to justify high salaries and bonuses when compensation is linked to company performance. Next. There are different there are different law enforcement related to these three offences. The several of law enforcement of money laundering are include under Section 613 Anti-Money Laundering, Anti-Terrorism Financing and Process of Unlawful Activities Act 2001, which had provided and dealt with the offence of money laundering. The action has taken to prevent the money laundering and terrorism financing offences. This is done to protect the loss of property involved in or derived from money laundering and terrorism financing offences. It is including terrorist property, proceeds of unlawful activity, and instrumentalities of an offence, and for matters that are related to. There are also several common tax offences in Malaysia that related with tax evasion, such as Section 113 Sub 1 of the Income Tax Act for people who evading tax by underclaration of how much they earn, and Section 114 of the Income Tax 1967 for who people not paying the tax, in which they can be punishable by a fine of Rm 1,000 to Rm 20,000 in addition to 300% of the tax that try to avoid paying. On the other hand, for the fraudulent financial reporting, individuals must follow approved accounting standards that are defined in Financial Reporting Act 1997 as accounting standards which are issued or adopted by MASP. Next. The similarities of money laundering, tax evasion, and fraudulent financial reporting is all of them have same financial nature. All of these three activities are illegal and unlawful, which involve the violation of laws. Besides, they also result in the same consequences, which is the offenders will either be punished by a fine or by imprisonment or by both. Next, I will pass to Alia to explain the manner how the activities was committed.
Thank you, Alpha. So I will continue with manner how activities committed by the fraudster in each activity. So the first one is money laundering, which consists of smurf, whereby a money launderer wants to avoid any critical observation or examination by the government. There will be multiple steps such as placement, layering, and integration steps in order to hide the money. For example, the large amount of money will be split and deposited into multiple different banks with the smaller amount to make sure it is unknown. Then there will be also money mules who are on the scheme or may be recruited unknowingly. The person hired by a money launderer will be promised with a large pay after doing the job in return and also carry the large amount as well. Next, for the tax evasion, the fraudster will use the fake documentation in order to claim exemption. It can be done by taxpayer who do not qualify created documents and falsify the details in order to also be eligible to claim those exemptions. The next one is under-reporting income, which become one of the common use by taxpayer of tax evasion. It can be described as a taxpayer intentionally reporting less revenue than originally received to have a reduction in tax. For example, the landlord who already has the tenants but has not declared or informed authorities about their income. The next one is fraudulent financial reporting. The first way is manipulation, falsification, or alteration in the financial statement by increasing the revenue and gains and also decreasing the expenses disclosed in the financial statement. Here is an example of recording revenue. A company records revenue before completing the service or product shipment. Thus, the money recorded as revenue is only the expectation of the business, not the actual transaction. Next way is record fictitious revenue. It consists of fake customers buying the product and the manipulation of depreciation policy to reduce the expenses. Next, I pass to the next presenter.
Alright, thank you, Adia. Okay, now I will proceed with the factors that influencing fraudster to engage in money laundering, tax evasion, and also fraudulent in financial reporting. The first factor for money laundering is corruption. For example, a person who have powers such as politicians, statesmen, or minister, they may accept bribes and prefer to invest the proceeds in foreign banks and other investment. They will avoid transferring it to local or personal bank accounts in order to keep the bribe amount hidden from local financial auditing authorities. As a result, their corruption causes a flow of cash to foreign banks, or it may lead them to conceal their financial asset as well as their sources of income. Another source of money laundering is the weakness and inadequacy of countries' financial regulation and relevant authorities. If the tax department is still unable to question politicians, elites, and the general public about their earnings and monetary and non-monetary assets, it is not difficult for people to hide taxes and engage in money laundering. Countries' financial regulatory authorities that have poor policies and financial regulatory, they may have loopholes that could allow politicians and the elite classes to conceal the details and sources of their assets. Another reason for untraced money laundering is banks' failure to detect and report laundered funds in their reserve. Unfortunately, there is no automated mechanism has been developed anywhere in the world to accurately track down the source of money. As a result, the issue remains unresolved and unrestrained, causing banks to fail to perform adequate examination of the funds that arrive at their branches, which will actually encourage money launderers to transfer funds to foreign banks without any fear. Next is factors that lead to tax evasion. When taxpayers have low tax ethics, they neglect to pay their due tax and engage in tax evasion. A demographic and another factors such as income level, marital status, and religion may influence tax morality. Involvement in paying tax is determined by the behavior of taxpayer itself. Other than that, when the tax rate is not reasonable and fair, taxpayers will regret engaging in tax evasion and will report their annual income without denying the exact amount. The governments decide in what amounts and on whom to impose a high tax burden. The tax rate is a factor that encourages taxpayers to pay a smaller portion of their income in taxes. The third factor is tax knowledge. When taxpayers perform routine tasks without tax knowledge, they may be exposed to certain risks that could lead to tax evasion. Due to insufficient understanding of the consequences of tax evasion, taxpayers are more likely to commit tax evasion. The last factor is subjective norms. The most important thing that makes people pay their taxes is what their significant other things. Social norms affect people's plans to pay taxes, which in turn makes people more likely to follow their own personal tax rules. It also says that taxpayers are more likely to not pay their taxes if they think that not paying taxes is common and that most people don't think it's a big deal. Alright, lastly, let's move on to factors that influence fraudulent financial reporting. The first factor is financial leverage. A large amount of debt, on the other hand, can increase the possibility of fraudulent financial reporting because it shifts the risk away from the owner of the capital and the manager and onto the owner of the debt. As a result, creditors are hesitant to make loans because of the high risk of default. Lastly, company management may manipulate its financial statements in order to meet certain debt requirements. The second factor is profitability. Companies with low profit may encourage management to overestimate revenues or expenses, resulting in significant errors in their financial statements. Managers do this in order to achieve management objectives. One of the management goals is to maximize shareholder value. Increasing shareholder welfare is an important indicator of managerial success for company executives. Finally, the last factor is liquidity. The higher the ratio, the lower the risk of the company failing to pay off its short-term debt. Companies with low working capital to asset ratios, on the other hand, indicate that the company is unable to meet its obligations. Managers may commit fraudulent financial reporting practices as a result of a lack of liquidity. This is because external parties such as creditors analyze and consider liquidity ratios when granting credit to businesses. Alright, next I will pass back to Alia to present the next topic.
Thank you, Aisha. I will proceed with the second part about the conventional and Sharia audit framework. Next. Conventional is economic actions and event complying with relevant standards, while the Sharia audit framework needs to comply with fatwas, rulings, and guidelines issued by the Sharia Supervisory Board. So I pass to the next presenter.
Thank you, Alia, for the invitation. So I will tell about the difference between Sharia audit framework and conventional audit framework. So the first difference is the cost. The role of the auditor is an Islamic economy is more expensive because Sharia auditors are accountable to society as a whole and must uphold Islamic principle. So the second one is religious accountability. Sharia auditor and internal review are held to a higher standard of religious accountability. So next slide. So the third is product. So interest on loan and deposit are forbidden among Islamic banks, even though Islamic bank prohibited the idea of interest on the transaction. They do not reject the time value of money. This is how the financial from the perspective of Islamic banking generating their income out of Sharia transaction. So the fourth is standard and guidelines. The Financial Service Act in bracket FSA of 2013 and the Banking and Financial Institution Act of 1989 govern how conventional banks function. So, while Islamic bank must be abide by the GPAI reporting guidance published by Bank Negara and the 2013 Islamic Financial Service Act (IFSA), that this recommendation must be taken into account when conducting audit in order to determine the degree of financial statement and the appropriate audit technique when examining the institution. So next slide. So for the fifth is reporting. According to Bank Negara Malaysia, there are various reporting requirements for the conventional and IFIS. So conventional banks must be comply with BAFIA Section 41, which mandate and that banking institution submit audited financial statement to the appropriate Jabatan Penyeliaan Konglomerat Kewangan or Jabatan Penyeliaan Perbankan Bank Negara Malaysia within 3 months after the end of the fiscal year. Additionally, Section 41 in Sub 4 of the Act exempt traditional banks must from publishing or presenting their annual audited financial report at their annual greeting meeting. So the last difference between them is long-term is a risk management feature. Long-term loan and bridge finance from the traditional bank. Lending decisions are not based on the freezing of capital asset. Furthermore, traditional banks only adhere to traditional regulatory requirement. Islamic Bank, on the other hand, offer funding since it is asset-backed. It generates profitability economy activity that prevent inflation. So next slide. So the similarities between Sharia audit framework and conventional framework is firstly, Sharia and conventional auditor are not obligated to stop or spot financial statement fraud or other problems. Secondly, if they came across any fraud during audit training and did not look into it further, they may be held liable and even face legal action. He or she should always think about how the ramification will affect other audit areas. The auditor should bring the issue to the attention of an appropriate level of management, at least one level above those engaged if the ensuing mispresentation has no major impact on the financial statement. So I will pass to the next presenter for the challenge card issue.
Alright, thank you, Adnan. So next, I'm going to discuss on the current issues and challenges of Sharia audit. The first one is the poor availability of the competent resources. The first issue is related to the competency of Sharia auditor. In order to understand and perform the Sharia audit, an auditor must have a good knowledge in accounting and also in Sharia. Otherwise, this subsequently may fail in determining the vision and mission of Islam that preserve within the Islamic financial industries. The university took the responsibility in producing graduates which are equipped with the comprehensive knowledge in Sharia audit. In Malaysia, there are only a few local universities that offer Sharia audit as a part of the subject in the accounting course, such as Islamic International University and Selangor International University College. And only one local university is offering a course specialized in Sharia audit, known as Master of Accounting and Sharia Audit, which is offered by Islamic Science University of Malaysia. Next slide. So my second point is the need to improve the existing framework. Some of the challenges that could weaken the Sharia audit practices, including the absence of a standalone Sharia audit framework, and the absence of specific standards and guidelines for external and internal providers of Sharia audit. Most Islamic financial industries use the conventional auditing method because of the non-availability of Sharia audit system. The Sharia scope is only conducted when Sharia issues occur and not comprehensively on the internal control measures. Next slide. Alright, the third issue is the independent positioning of internal auditor in presenting the report. The integrity of Sharia auditors could be further enhanced if they are independent enough to give opinions on the position of the Islamic financial industries in being Sharia compliant. Sharia audits can be carried out by internal auditors or external auditors, provided that they have sufficient Sharia knowledge and training. Sharia auditors must be more accountable to the stakeholders, including the shareholders, the community, the ummah, and essentially they are accountable to Allah for all their actions and inactions. So next, I'll pass to Hanini.
Okay, thank you, Hanisa. So now let's move to the next slide, which is practical way towards an effective Sharia audit. The first one is role of regulator and financial institution. As we know, the Central Bank of Malaysia, which is Bank Negara Malaysia, who is the regulator and also the financial institution, will be in charge of establishing professional standard for Sharia auditors, scope definition and skill sets. Therefore, there is a need to have a solid framework for internal or external auditor and for regulator to check on a consistent basis that the Sharia auditor perform on their work according to Sharia principle. The second one is the qualification and innovation in Sharia auditing need to be expanded. Internal auditors should have the necessary skill and qualification to expand their capabilities where they will be able to conduct a normal conventional auditing while also specializing in Sharia auditing. Besides, internal auditors should importance their skill set and activities as well as becoming more proactive in their jobs. Other than that, innovation is also required by the development of an audit change management program, which encompasses a data management IT system and regulatory requirement in Sharia audit. And the third one is roles of professional bodies and association. There is a need for the professional bodies and association to undertake the role of developing and should play a role in creating talent to meet the industry needs through providing professional Sharia certification courses and training programs. It is important to equip the Sharia people with the necessary professional skill and Sharia awareness and knowledge. Stakeholder also engagement is needed in the development of Sharia audit talent. So the fourth one is program at a higher educational level. The provision of a standalone program or the integration of a Sharia audit course into existing accounting program could provide an avenue for producing knowledgeable and competent personnel. Definitely, high caliber Sharia audit personnel will help to improve the credibility of Sharia compliance and accountability in the activities and operations. In addition, such program would supply the appropriate human resource required by the institution financial Islami as well. Hence, the confidence of stakeholder, customer and the general public will improve substantially as the current system is dominated by with the inadequate Sharia. Okay, the fifth one is there is a need to make the Sharia audit a profession through There is a need to make the Sharia audit a profession through the establishment of a separate professional body that would enhance the capacity to employ the right types of people as a professionals. Moreover, to increase the greater number of competent Sharia auditors, immediate attention for a future pool of resources with the help of higher learning institution and higher recognition through the introduction of professional certification is highly demanded. Furthermore, it is important to ensure that a continuous professional development or education is provided to help auditors to keep up with changes or development in the industry. The last one is Sharia compliance. Culture should be strengthened through continuous training to all employees. Lack of understanding and ignorance will become serious obstacles which might create more negative attitudes and perception towards Sharia compliance practice. Thus, effective training will enhance awareness and knowledge which are translated into a higher level of employee commitment. So next, I will pass to the Alia.
Thank you, Hanimi. In conclusion, the auditors need to take into consideration the actions that need to be taken, emphasizing the current issues that arise in auditing, involving money laundering, tax evasion, and fraudulent financial reporting. The fraudster need to be identified and each transaction need to be verified and have a clear explanation. While in terms of the second topic, which is the Sharia audit framework, Malaysia itself need to expose more professional studies to have a certified Sharia auditor through a certification program in order to create the auditor with high proficiency, as it is considered as the new area in Islamic finance. That's all from us. Thank you.